Welcome back to the deep dive. We're jumping straight in today, right into what you could call the real nerve center of global finance. Look, if you've ever wondered what really sets your mortgage rates or influences whether companies are hiring or, shakes up your investments, even crypto prices, then you need to get your head around the bond market.
It really is the engine room, isn't it?
Mm.
We're talking about a market worth over $1 trillion globally. It basically sets the price of money for everyone. Governments, big corporations, startups, even affects you directly. But yeah, it often feels hidden behind all this jargon.
Absolutely. And that's our goal today. Not just throwing definitions at you, but really unpacking how it works, the key terms, and importantly, why it matters in the real world. We want to give you that shortcut so when you see headlines about bond yields moving, you actually know what's going on.
Right, let's break it down.
Okay, but before we properly dive in, a quick welcome to vpod.ai. This deep dive is sponsored by Stonefly. They're leaders in enterprise storage, backup and disaster recovery, AI storage, and cloud solutions. And importantly, if you're looking for really secure, like ransomware-proof storage, Stonefly sells air-gapped and immutable storage. That means your data is properly locked down, it can't be compromised remotely. So if you want to see how they can secure your business, contact sales at stonefly.com to set up a demo. All right, let's start right at the beginning. What is a bond? Fundamentally, it's really just debt, isn't it? Imagine you need, say, $100,000 for a business idea. A bond is basically the formal IOU you give to the person lending you the money.
That's the heart of it, yeah. When a company, or much more often, a government needs money, they issue a bond. They become the issuer, the borrower. And whoever buys that bond could be a big bank, could be you. They're the investor, the lender. And that promise is key. You agree to pay back the original amount, that's the principal. And usually, you pay interest along the way. That's the coupon.
Okay, but governments are the biggest players here. Why? Don't they just collect taxes? Why borrow so much?
Well, they do rely heavily on taxes, obviously. But governments have huge ongoing expenses. Think about massive infrastructure projects, roads, bridges, the military, healthcare. These things need funding now. And borrowing isn't just about plugging gaps. It's also kind of strategic.
Strategic how?
When the government borrows and then spends that money, it injects cash directly into the economy. It can boost growth, create jobs, and a healthier economy down the line should generate more tax revenue. It's meant to be a cycle, ideally.
Right. And we saw that point about tax reliance illustrated pretty starkly. Like in the UK, something like only 11% of government revenue is not from taxes. So nearly 90% comes from tax income.
Yeah.
Which really shows why borrowing isn't just optional for them, it's essential to keep things running.
Exactly. It's a core tool for funding public services.
No, but thanks.
And all this borrowing adds up. When a government spends more in a year than it brings in through taxes and other revenue, that shortfall is the budget deficit for that year.
And if you add up all those deficits, all the borrowing from previous years that hasn't been paid back yet, that gives you the national debt. And this is where the numbers just get, well, frankly, kind of mind-boggling.
They really are staggering.
Yeah.
As of this year, 2025, the UK's national debt is around $2.7 trillion. The U.S., it's sitting at a massive $36.7 trillion.
Wow. Okay. So where does all that money actually come from? Who's lending trillions to governments?
It mainly comes through treasury auctions. Governments regularly sell new bonds to raise money, and the buyers are global. Other governments buy them. Big pension funds need safe places to park cash. Insurance companies, banks, even regular individuals through funds.
Yeah, I always hear that U.S. government bonds, treasuries are like the safest investment on the planet, but you hear that $36.7 trillion number, you see political fights about the debt ceiling. Doesn't that safest label feel a bit shaky sometimes?
It's a reasonable question. The safety isn't really about the U.S. never being able to pay. It's more fundamental than that. U.S. Treasury bonds are considered ultra-safe because the U.S. dollar is the world's main reserve currency. So much global trade happens in dollars. This creates essentially almost limitless demand for U.S. debt. Plus, it means Treasury bonds are incredibly liquid.
Liquid meaning you can sell them instantly, anywhere, for cash. No waiting around.
Exactly. They're the benchmark safe asset globally. So the fear isn't really a U.S. default, like they just can't pay. The more realistic anxiety for bondholders is that the U.S. might just print more money to handle the debt, which technically means they can pay, but doing so could devalue the dollar through inflation, eating away at the real return for the bondholder. That's the worry.
Okay. So it's less about if they pay and more about what those payments are worth.
Precisely.
Right. Let's nail down the language then, because you hear these terms thrown around constantly. We mentioned principal, the initial loan amount. What about the coupon?
The coupon is that fixed interest payment you get. When the bond is first sold, the government might say, we'll pay 3% interest each year on this bond.
Mm-hmm.
And for that specific bond, that 3% rate, that dollar amount per year, never changes until the bond matures. It's locked in.
Okay, fixed payment. Then there's maturity. Simple enough.
Yeah, that's just the end date, the day the government pays you back your original principal. Maturities vary wildly. You have short-term treasury bills maturing in months, or long-term bonds that might not mature for 30 years.
30 years is a long time. What if you need the money back sooner? Can you sell it?
Absolutely. That happens all the time in what's called the secondary market. You can sell your bond to another investor, but the price you get depends entirely on what interest rates are doing in the market at that moment. And this brings us to maybe the trickiest but most crucial term, yield.
Oh, okay.
Yield is the actual return you end up getting on the bond based on the price you paid for it and the fixed coupon payment. It's not the same as the coupon rate necessarily.
Right. The coupon is fixed, but the bond's price can go up or down in that secondary market,
Right.
and that changes the yield for the new buyer. Can you walk us through that inverse relationship again? Because this seems key. Price goes up, yield goes down.
It is absolutely the linchpin. Let's use an example. Say you bought a $1,000 bond directly from the government. It pays a $50 coupon each year. So initially, your coupon rate and your yield is 5%. $50 divided by $1,000. Simple.
Okay, 5%. Got it.
Now, fast forward a year. Let's say overall market interest rates have jumped up to 6%. Nobody's going to pay you the full $1,000 for your bond that only pays 5%, right? They can get 6% on new bonds.
Right. Mine looks less attractive.
Exactly. So to sell your bond, you have to lower the price. Let's say you sell it for $900. The new buyer pays $900, but they still get that same fixed $50 coupon payment each year.
Ah, okay. So for them, the return is $50 divided by the $900 they paid, which is carry the one, about 5.55%.
Precisely. The price of your bond went down from that $1,000 to $900, but the yield for the new buyer went up from the original 5% to 5.5%.
Price down, yield up.
And the reverse is also true. If market rates fell to, say, 4%, your 5% bond would look great. People would pay more than $1,000 for it. Maybe they pay $1,100. They still only get $50 a year, so their yield, $1,100, would be lower, about 4.5%.
Price up, yield down. Okay. That inverse relationship is critical.
It drives everything.
So these market prices and yields, how are they actually set day to day? You mentioned auctions.
Yeah, it starts in the primary market. That's when the government holds those scheduled auctions to sell new bonds. The yield agreed upon in that auction, basically, what interest rate investors demand to lend the money right then, that sets the benchmark for similar bonds. And it's purely down to supply and demand at that moment. If investors are worried about inflation eroding their returns or the economy looking shaky, they'll demand a higher yield, a higher interest rate to compensate for that risk, which means borrowing costs more for the government.
Okay, so new bonds set the initial benchmark. Then they start trading between investors.
Exactly. That's the secondary market. It's enormous and operates constantly. Investors are buying and selling existing bonds, and they're not just looking at today's interest rates. They're constantly trying to guess the future. Where are central banks heading with rates? What's inflation going to do? How healthy is the economy? Is hiring strong or weak?
Right. You hear analysts constantly talking about jobs reports in relation to bonds. Why is employment data such a big focus?
Because a really strong job market often signals potential future inflation. Lots of jobs, rising wages, that can push prices up. And if investors expect higher inflation, they'll demand higher yields on bonds now to protect their purchasing power later. So good economic news can sometimes be bad news for bond prices.
Interesting paradox. So effectively, the interest rate the government has to pay when it borrows today is dictated by the collective guess of millions of global investors about the future.
That's a good way to put it. It's the yield the market currently demands.
Which brings us back to those massive debt numbers. If market yields go up, the government's borrowing cost on new debt goes up too.
And that's where it becomes a real problem, almost a compounding nightmare. Take the U.S. debt, that $36.7 trillion. The interest payments on that debt are currently estimated to be around, wait for it, $3 billion per day.
It's $3 billion every single day, just on interest.
Just servicing the existing debt. It's an almost unimaginable number.
How is that even sustainable?
Well, it's made worse by something called the debt rollover. Governments don't just issue 30-year bonds. They rely heavily on short-term borrowing bonds that mature in maybe 6 months, 12 months, 18 months. This means they are constantly having to pay back maturing short-term debt by issuing new debt. They roll it over.
And that new debt gets issued at whatever the current market interest rate is.
Right, exactly. So if interest rates shot up 2 years ago, the government doesn't feel the full impact immediately on all its debt. But as billions or trillions of that short-term debt matures each month or quarter, it has to be refinanced at today's higher rates.
So the pain is delayed, but it keeps building as more debt rolls over at the higher cost.
Correct. And the consequence is stark. A bigger and bigger slice of the country's total economic output, its GDP, has to go just towards paying interest on the debt. That's money, that $3 billion a day that isn't going to healthcare or infrastructure or defense or education. Unless, of course, the government borrows even more money just to cover the interest payments, which just digs the hole deeper. It's a dangerous cycle.
Okay, so government bonds are seen as basically risk-free, setting this baseline risk-free rate. How does that connect to the stock market, which feels like a completely different beast?
It's a really direct connection through something investors call the equity risk premium, or ERP. Think of it as the extra reward investors demand for taking on the risk of owning stocks compared to the guaranteed return they can get from safe government bonds.
Okay, so it's the gap between expected stock returns and that risk-free rate from bonds.
Yeah. What happens if the yield on those safe government bonds goes up? Say, you can now get a guaranteed 5.5% from a treasury bond. Well, that risk-free rate has risen. So the gap between that safe return and the potential, but risky return from stocks gets smaller. The ERP shrinks.
So the extra reward for owning stocks isn't as big anymore, relatively speaking.
Precisely. Why take all the roller coaster risk of the stock market if the safe option is suddenly paying you a much more attractive rate? It makes stocks look less appealing. Investors might start selling stocks and moving money into bonds to lock in that higher, safer yield.
Which is why rising bond yields often hammer stock prices. Makes sense.
And this risk assessment extends beyond just government bonds versus stocks. It affects corporate borrowing, too.
Because companies also issue bonds to raise money, but they're obviously riskier than governments, right? A company could actually go bankrupt.
That's right. There's credit risk. And investors demand a higher interest rate from companies to compensate for that extra risk. We measure this difference using the high yield spread. It's basically the gap in interest rates between riskier corporate bonds, sometimes called junk bonds, and safe government bonds.
So the high yield spread is like a fear gauge for the corporate world.
That's a perfect way to describe it. Think of it as the market's temperature reading for corporate stress.
So if that spread widens, the gap gets bigger, it means investors are getting nervous.
Very nervous. They're demanding a much, much bigger premium to lend money to companies they see as risky. A widening spread is usually a bad sign. It signals investors fear defaults are rising or the economy is heading for trouble.
And when that happens, borrowing becomes super expensive for those companies, forcing them to cut back on investment, hiring.
Exactly. It puts the brakes on economic activity. So you see, the bond market isn't just reflecting the economy, it's actively shaping it. Rising rates demanded by bond investors directly slow things down.
Wow. Okay, so wrapping this up. What's the big takeaway for you, the listener? I think it's that understanding the bond market, even just the basics like yield and its inverse relationship with price, is absolutely essential. It's the core mechanism controlling the cost of money everywhere. It impacts government finances, your mortgage, your job prospects, your retirement savings. It really is central.
It truly is. And maybe a final thought to leave you with, something to mull over. Given that U.S. debt is $36.7 trillion, and so much of it is short-term debt that needs constant refinancing, what happens to the U.S. economy, to its ability to fund everything from roads to healthcare, as those $3 billion a day interest payments inevitably keep climbing whenever rates are higher? It's a massive long-term question with no easy answers.
A critical question indeed. Well, that's all the time we have for this deep dive. Thank you for joining us.
My pleasure.
And one final thank you to our sponsor, Stonefly. Remember, if data security is paramount for your business, Stonefly offers those air-gapped and immutable storage solutions. They are leaders in enterprise storage, backup, disaster recovery, AI storage, and cloud. For truly secure ransomware-proof protection, get in touch with them. Contact sales@stonefly.com to schedule your demo. Thanks for listening, and we'll see you next time.